All right, let's jump right into this explainer. Today, we're doing something intensely practical and honestly pretty revealing. We are putting on our sell-side equity analyst hats to perform a rigorous fundamental valuation on Nauticus Robotics, ticker symbol KIT. Now, spoiler alert right up front, this company is flashing some absolutely severe financial distress signals. But hey, as focused learners, we don't just look away from a car crash, right? We analyze the physics of it. We're going to stick strictly to the provided data to uncover exactly what happens when traditional valuation models literally collide with highly distressed financials.
So here's our game plan for today. We'll start with the analyst's baseline view, then we'll attempt a DCF valuation. After that, we'll look at discarded valuation models, do a relative valuation reality check, and finally, end with asset-based liquidation. Okay, Section 1, the analyst's baseline view. Before we even think about building any complex models, we've got to open the file and confront the brutal reality of the underlying financial metrics we've been handed. Just take a second to absorb the sheer shock value of this number, negative 3,921%. That is the trailing 12-month net profit margin for Nauticus Robotics. To put that into perspective, a healthy company might run a net profit margin of 10, 15, maybe 20%. Even a company going through a rough patch might dip into the negative single digits. But negative 3,900%? There's no way around it. This is an immediate shock to the system. It basically tells us right out of the gate that traditional valuation is going to be incredibly difficult. It literally means that for every single dollar of revenue this company brings in the door, they are hemorrhaging over $39 in bottom-line losses. Let that sink in. Looking at the raw baseline numbers, the scale of the disconnect is just massive. We're analyzing a microcap asset with a total market cap of just over $10.2 million. They generated only $4.68 million in trailing 12-month revenue. Yet, and this is the kicker, their net income is a staggering negative $140.25 million. Obviously, this has resulted in a trailing total return for shareholders of negative 95.81%. On top of that, the actual cash bleeding out the door, the free cash flow, sits at negative $23 million. These metrics absolutely scream severely distressed asset.
Moving right along to Section 2, attempting the DCF valuation.
Now, as analysts, it is our duty to attempt an absolute valuation to derive some sort of intrinsic value. To build a discounted cash flow model, normally we'd forecast future cash flows and discount them back to today's value based on unlevered free cash flows. But, well, we hit an immediate hurdle. Our starting unlevered free cash flow base is negative $23.018 million. Plus, the provided source documents completely lack management's forward projections. So what do we do when required data points are missing? We rely on sensible, clearly stated defaults. We'll assume a standard 10 to 12% weighted average cost of capital, or WACC, and a modest 2% terminal growth rate to reflect long-term inflation. But pay attention to what we're applying these rates against: a deeply, deeply negative starting cash flow base. So here is the crucial takeaway. No matter how sensitive we make our default discount rate assumptions, or how generously we try to model some sort of miraculous recovery without explicit forward guidance, the DCF model completely breaks down. Under the heavy weight of that negative $23 million free cash flow base, the future cash flows remain deeply negative across the entire forecast period. And you know the math. When you discount negative cash flows, you get a negative enterprise value. Since a stock price obviously cannot be negative, the resulting intrinsic value per share in our DCF model is mathematically zero, period. All right, on to Section 3, discarded valuation models.
Let's talk about why certain standard textbook models just have to be decisively thrown out the window in an autopsy scenario like this. In a normal fundamental valuation, we'd absolutely consider the dividend discount model, the DDM, which values a stock based on predicted future dividends. But we can't apply a DDM here. Based on our data, Nauticus has zero historical or stated dividend policy. The trailing 12-month dividends compound annual growth rate is exactly 0%. You just can't discount a cash stream that flat out doesn't exist.
Next up, we might naturally try a sum of the parts valuation. Break the company up, value distinct business segments independently.
Sometimes one division is failing, but another holds some hidden, locked-away value, right? Unfortunately, SOTP is totally out of the question here too. The provided financial filings have a complete lack of distinct reportable business segments or varied risk profiles. We simply can't parse out any hidden value when the data only gives us a single, consolidated view of a failing entity.
And finally, we look at the residual income and adjusted present value models. Residual income relies on the book value of equity and forecasting net income to calculate an equity charge. But look at these inputs. The return on equity is a catastrophic negative 3,401.68%. Good luck calculating a reliable equity charge with inputs that insanely noisy. It's impossible. Similarly, APV values operations as if they were all equity financed and adds the tax shields from debt. But with a debt-to-equity ratio of negative 7.29, this capital structure is severely destabilized. So, both of these models? They must be strictly discarded.
Let's pivot to Section 4, Relative Valuation Reality Check.
Since our absolute models are totally starved for positive inputs, we have to pivot and compare Nauticus to the broader market. In relative valuation, we look at market multiples. Now, because specific comparable companies aren't explicitly identified in the source text, we've got to make an external assumption and group them generally with subsea robotics and industrial tech peers. But almost immediately we hit a brick wall. Traditional metrics like the price-to-earnings ratio or EV to EBITDA, they are virtually meaningless when earnings and EBITDA are vastly negative. I mean, KITS PE ratio is negative 0.02 and their EV/EBITDA is negative 0.33. You literally cannot apply a peer median multiple to a negative baseline and expect to get anything useful.
Now, some analysts out there might try to salvage a relative valuation by pinning their hopes on the EV to sales ratio, which sits at a seemingly normal 1.53. But let's apply some critical thinking here. Can you honestly compare a normal, healthy peer group to a company that is actively destroying capital? The return on invested capital, ROIC, for Nauticus is negative 78.04%. This means for every single dollar invested into the business, they are actively destroying massive amounts of value. A revenue multiple is just an illusion of health when the cost of generating that revenue is so incredibly destructive.
Which brings us to Section 5, Asset-Based Liquidation Value. Because literally all other models have failed us, we must evaluate the absolute worst-case scenario. We have to ask what happens if we simply strip this company down to the studs and sell the parts to cover the liabilities. First things first, we check liquidity. Take a look at the current ratio at 0.21 and the quick ratio at 0.19. In the accounting world, anything below 1.0 means a company cannot cover its short-term debts with its short-term assets. So ratios of roughly 0.2, they practically scream that current immediate liabilities massively overwhelm any liquid assets on hand. The company is, for all intents and purposes, illiquid.
So, we calculate the expanded liquidation value. We look at the total enterprise value to assets ratio, which is barely 0.17. We look at the debt-to-equity ratio, a wildly unstable negative 7.29. When we mentally restate the balance sheet to fair market value and subtract all these overwhelming liabilities, the math is totally unforgiving. After paying off the debt holders and the liability claims, the estimated net proceeds for common equity holders in a standalone liquidation event effectively equals zero. Nada.
And that brings us to the end of our rigorous fundamental analysis. It's honestly a stark reminder of the limits of financial modeling in highly distressed situations. Every structured model we have in our toolkit, from discounted cash flows to relative multiples, all the way down to a basic asset liquidation, yields an intrinsic value of zero based on the current financial reality. Which leaves us with a fascinating, highly provocative question. At what point does investing transition from calculated valuation to pure speculative survival? When a stock's fundamentals completely flatline, are you actually buying a financial asset or just a lottery ticket on a ghost ship? Thanks for walking through this analyst autopsy with me. And remember, always keep questioning the numbers.